Lots of positive news on the stock market rally. And I was actually surprised to hear this in the Wall Street Journal. So I still subscribe to the Wall Street Journal. It costs me $48 a month for the electronic thing. One of these days I'll cancel it, but every now and again I get a tidbit that I like. They're just so freaking anti-Trump and pro-globalist. I can't. I can't. It's bad. Wall Street Journal reporting has always been left-wing, at least since I've been following this stuff in the early 90s. Always been left-wing. I'm just telling you right now. They had John Harwood used to be on there, Jackie Calms. They just, they have a number of people go back and forth from the Wall Street Journal, the New York Times, whatnot. It's the editorial page in the finance section, which is always what kept me. The editorial page has gone real globalist, more so than I can even possibly remember, and I can't stand it. But anyway, but still, I get some good tidbits on there once in a while. It's becoming less and less hard to justify the fee. Anyway, so they wrote a broad market rally was not led by the Magnificent Seven. Industrials and utility companies are leading the broad market rally. And dude, that's good to hear, because what a lot of people, myself included, said, man, these Magnificent Seven are representing too much of the S&P 500. And that can't be a good thing. Not that the S&P 500 is going to go to zero, but whenever you're led by a small section of companies, if that small section rallies, you're loving it. If that small section gets defeated for whatever reason, you're hating it. It's exactly what happened in 2007, 8, and 9, and then 2001 and 2 again. Because you have the biggest companies, the S&P 500. This is the whole thing with trends and momentum investing. You can really make money on trends and momentum, but it can turn on you like that on a dime. And so when the S&P 500 gets rocked, you always hear, well, the broad market, the equal-weighted S&P 500, a Wellington fund, for instance, which has some bonds, outperforms the S&P 500 simply because it's more diversified at 100%. And the only way to beat the S&P 500, as I've been saying for years and years and years and years, is to have a more concentrated portfolio. That's it. Because at the end of the day, while the S&P 500 is diversified in terms of got 500 stocks, it's very top-heavy, just a fact. And which means it's inherently concentrated, all right? You're not going to beat the S&P 500 with a closet index. You're not. I mean, there's just the evidence against that is, you just look at Fidelity Magellan. Because your fees, S&P 500 has no internal fees. Now, if you buy an S&P 500 index, there are internal fees, but it's very limited. But still, Fidelity Magellan, I don't care what fund it is. If they're charging you 50 basis points, inherently, that's 50 basis points you got to overcome by beating it to outperform the S&P 500. All right. And it's just, you're not going to be able to do it on a routine basis. It's just, you can't. This isn't rocket science anymore. Bogle made this his thesis in like 1950s in his dissertation. Then he was able to gather enough investors to start the real first index fund in 1976, something like that, with the S&P 500. There was one before that, but no one knew about it. It wasn't MFS. But anyway, the real first fund was Bogle's, based off his thesis that he had written in like the 50s when he was in college. Anyway, so what happens here is that when the S&P 500 gets top heavy, well, that's great when the rallies, as long as those companies that make it top heavy rally. Those companies that get hammered, well, the S&P 500 gets hammered more than a more broad-based investment portfolio. It's just a fact. And that's why, again, equal-weighted S&P 500 outperformed the market cap weighted S&P 500 and the aughts, because equal weighted S&P 500 had every single company within the S&P 500 was 1/500th of the S&P 500. All right. So Microsoft was 1/500th, and I don't know, Pets.com was 1/500th, which means nothing took off and nothing got smoked relative to the S&P 500 as a whole, which back then was very large cap growth top heavy. Another reason why the Wellington Fund, for example, did not suffer the same consequence, well, because of bonds, obviously, but it's more value oriented, all right? And so the value stocks did not get hammered the same capacity as growth stocks did and the odds. It just didn't happen. And so as such, value stocks, well, they got hammered in 2020 to 2002 and 2008. They didn't get hammered in 2000, 2001. They just did not. So what does that mean? Well, now we have a broad-based market increase, not backed solely on the backs of the freaking big seven, the Amazon, Nvidias, and whatnot. Industrials, utilities are leading the way, and the S&P 500 is still rallying. And this is huge, man, because it just says there's more market breadth, than what it has been for a long time. And that makes me happy. So as Nvidia, the big seven, they're not taking on the chin. They still have had a massive rally themselves, don't get me wrong. But as they're being out-rallied by stocks that haven't done so much in the previous 10 years or so, this is good news. This is good news. Again, it's a widening market rally, which means most likely there'll be more room for to run, as long as the big seven, which are still massively heavy, the S&P 500, don't falter. All right, and that's a concern. If those companies falter, because there's still a large representation of the S&P 500, you're still going to get pain without question. So even if those companies just go sideline, while the broader base companies catch up, you'll do okay. 100%. And then what will happen is it'll more measure out, more level out. So the concentration will be less, because again, right now, I think the last I saw, the big seven is like 35% or something like that of the whole index. I'm like, oof. And we saw that in 2022, when the tech stocks got hammered, 2020 or 2022. And that really put a whipping on the S&P 500. So we had like Dollar Tree and Dollar General were leading the way over this year. Trump is on a sales pitch to Middle East in terms of offering our technology to Middle Eastern countries, and that had a big market impact on Boeing and things like that. I haven't looked at the stock price of Boeing. I don't have any idea. I'm just quoting for the Wall Street Journal. But that's good news, man. A broader S&P 500 means there's less risk, because less stocks are running the whole show. Less stocks run the whole show. I mean, there's more diversification. More diversification means less potential for getting knocked heavily, like what we saw in the past decade. So good stuff, man. And again, you buy the index and leave well enough alone, you'll probably be more volatile than if you had an equal weighted S&P 500, or if you had a more diversified index where you have less concentration. But at the end of the day, you're not going to be able to beat the S&P 500 on a routine basis, especially if you're charging pretty significant fees. It's just not going to happen. So buy the index, hold your breath, and let that sucker do what it's going to do. It's done historically. All right, God bless.